The following is my conversation with Sam Nicols, the former CEO of YT Industries from 2020 to 2024. In this conversation, we have a candid discussion about private equity in the cycling industry. Sam brings an outsider's perspective from his decade at Amazon and strategic consulting at Bain. He experienced the full cycle at YT, the COVID boom, the PE investment frenzy of 20 and 21, and the painful restructuring that followed when valuations collapsed. We explore questions the industry whispers but rarely discusses openly. How do PE firms actually work? Why the investment rush during COVID? And critically, is private equity bad for cycling or just badly timed? Using straightforward analogies, Sam explains the mechanics of PE investments, why family-owned businesses weathered this storm better, and shares candid insights from navigating YT through both explosive growth and the restructuring that followed. This isn't about blame, it's about understanding the financial forces reshaping our industry and why timing, capital structure, and investment horizons matter more than most realize. This is the Business of Cycling podcast. Sam Nicols. Oh, I'm so happy, man. We had a podcast scheduled, and we were unable to do that, unfortunately. Yep. But I'm glad we got to reschedule this, and I'm really glad we were able to keep in touch, man. You are, for me, to have your contact and your input and your dialogue has been really a breath of fresh air, because you do come into this business as an outsider, and you've got a professional background, and so I guess today was one thing that I'm really happy to be able to do today, and happy that you're able to offer some time, is to introduce my audience to you and hear more about your story, and then the idea was that we would kind of dive into some areas of expertise of yours to kind of shed some light on the ownership structures, ownership and investment climate in the cycling business. So this is cool. I'm really excited, because it's like I do a lot of storytelling, a lot of founder journeys, management journeys, brand journeys, but this is more really we're getting into some deep business topics here, and I'm excited. So thank you for coming on, Sam. Where does this podcast find you today?
Well, thanks first of all for having me on, Wyatt. It's good to finally be able to record this. I'm sitting in Munich right now, where I've lived for the last 20 years.
20 years in Munich. And how's your German?
Well, the Germans say it's pretty reasonable. I get along just fine. I think it's probably as good as your Italian.
Serviceable. Okay, cool. Serviceable. So maybe should we just jump into what kind of where you're from, where you grew up? Give me
the short version.
And then we'll get into the meat.
Sam Nicols, as you can hear, I'm American. I grew up in Oregon and moved to Europe again 20 years ago. Started my career off in engineering, and then after 10 years of not really getting into it, I switched over, got an MBA, and then joined consulting. So I had a couple of years in a traditional strategy consulting role. Worked at Amazon for nearly 10 years.
What was your strategic consulting, the business you worked for?
It was Bain.
Bain, okay.
Yeah, it was manufacturing clients. It was pretty standard management consulting jobs, which was paid well and allowed me to delay making any decisions about my career. So it was a good, it helped me pay off my loans for my MBA and learned quite a lot.
Can you give us the Amazon, really super compressed version of what you guys did actually, specifically?
So management, well, at least my projects were manufacturing related. It was classical management consulting, where the executives come up with a project, or let's say the partners sell a project to a company. You show up, do a lot of interviews with the staff, do external research, build proposals and recommendations for the company to usually improve the bottom line. So it's either cutting costs or growing the business. I typically had projects that were around less cost cutting, more around improving quality. So reducing, indirect costs and areas of potential growth for companies. But it was intellectually really interesting, but it was always recommendations. And I think that was something that I learned a lot on how, let's say, the kinds of questions that businesses have, but didn't get to implement anything. So made lots of recommendations that then you leave the company, you don't know whether they worked or not, or even whether they were implemented. And after paying off my loans, I was ready to get into a job where I actually could achieve something, or actually sit around and implement things.
So the
And
lack of
then,
kind of touching and like seeing the results was sort of weighed on you a bit.
yes, correct.
Okay. And then you mentioned
Um,
you went to Amazon, which must have been early on at Amazon.
well, I mean, it was 2010 when I
Okay.
joined Amazon. At the time, I actually thought that I missed out on all the good times at Amazon in terms of
Right.
stock
Right.
growth, but it
Yeah.
turned out that that wasn't the case. Yeah, I mean, relatively early, although Amazon at the time was kind of emerging as the largest retailer in Germany, and hadn't it changed a lot over the time that I was there. When I joined, it was still a lot of decisions that were being made locally, and that was my first job, was learning retail in the video games business. So I was doing purchasing and negotiations with vendors, and learned the Amazon model of retail. And interestingly, fit really well with my background, being an engineer, being very data driven, not understanding retail at the time. And Amazon is a company that places a lot of value in using numbers to help make good business decisions. And there was a very high overlap of, let's say, how Amazon worked and the way that I like to work. So cultural fit, and I really, really enjoyed it. Certainly, the first 7 years were fantastic. Um,
And that would have been
Transitioned over to
Amazon
leading
Europe.
the Prime team. It was always in Europe,
Europe.
so
Okay.
Germany
So
predominantly, and then my last 2 years, I launched the Amazon Turkey business. It was a highly rewarding time. Learned a lot, and especially was surrounded by really, really smart people, and that's something that I really enjoyed, learning and being exposed to new problems and new ways of looking at things, and always relying heavily on the data. And was given the opportunity at the end to launch the Turkey business in kind of like an MD role. And Turkey was a really exciting and very challenging environment. And when that business was launched, and I had handed over to someone who was willing to move to Istanbul, which I wasn't ready to at the time, then I decided that my time was up there, seeing that the company had shifted over towards nearly full automation. I mean, there's systems and tools that are running the business, and the amount of, or let's say, the level of influence that you can have as a leader becomes less and less. It's a lot of high-end optimization and controlling or auditing of the business, and not so much making big decisions that have a big impact that you can see. And I was missing that. And about that time, I was then approached by founders of YT, so YT Industries in the mountain bike industry, direct to consumer. And I had known one of the founders for a couple of years. I'd met him during my time at Amazon, and they approached me about potentially taking over or joining YT as CEO. And I thought that was a fantastic opportunity, seeing that I
sure.
had been a lifelong biker. I've never commuted with a car in my life. I've always ridden my bicycle, or one of my bicycles. And while I had certainly had ideas of wanting to try and be a CEO during my career, I hadn't targeted the bike industry specifically. But when Jakob and Marcus came and approached me, for me, it got me really excited, because I've always been, like I said, into biking, into outdoors, YT being a direct to consumer brand, one that I felt that I could apply much of what I'd learned at Amazon in an environment where I was passionate about the products, and that it wasn't too far away from where I lived. So it was a great fit. I joined YT November of 2020
Wow.
and stayed there until February of 2024.
Right
And
in the midst of
in the
the
midst, I would say I saw, in 3 years, I think I saw more, the peak and the trough. I think I saw everything except for normalcy during that period.
yeah,
So
totally.
it was a big roller coaster ride. I had an amazing time. It was, I would say, the kind of my dream job, working with a dream brand and a great team, and was challenged in ways that I didn't expect that I would be, and confronted with many of the. I came into the job thinking I knew a lot more, that I was more prepared to be a CEO than I turned out to be. At Amazon, you learn a lot of things very well, but there are many gaps that are existing when you join a smaller company, and those proved to be a lot more challenging and took a lot more time to figure out. And obviously, well, the first couple of years running quite well, and then towards the end when the challenges came with the industry and a lot of decisions that we had made at YT turned out to not play out the way we had hoped. It led to YT turning into a restructuring case, and that was something that I didn't have experience at Amazon. I never learned restructuring, and in the beginning of 2024, I agreed together with the investor and with Marcus that I would step down from the CEO role and hand it over back to Marcus. Since then, let's say I've officially left my day job in the bike industry. And while I have another CEO job in retail, in camera retail right now, I'm still a member of the board of Propane, which is another direct-to-consumer mountain bike brand. So my evening job is still definitely involved in the bike industry, and why we see each other at bike events,
Yeah, we do.
random places around. So I found a way to continue to live out my passion.
Yeah, yeah, and you've come on and done a little bit of moonlighting with some potential partners and clients that I work with, and it's awesome to have you in my network, man. I really can't say enough. So, do we want to dive into YT, or do we want to switch over to the ownership structures? I know that there's a lot just recently had happened over at YT. That's up to you, man. If you want to go down that road, we can. Otherwise, we can switch over to the main topic. I know that when we had sort of set this up, everything was sort of up in the air, but now things have kind of shaken out.
Yeah, I think we had talked about what one of the, maybe I'll start with a bit more general approach of, there certainly has been a lot of talk about private equity, and I have a very specific experience. I have one experience with private equity within the bike industry, and that's YT. And I think there was one of the talks we've talked about is a bit of misconception around what private equity is in the bike industry, how prevalent it is. And so we had talked about kind of walking through a little bit about the bike industry, what kind of ownership structures exist,
Right.
what kind of dynamic comes out of private equity. Is it beneficial or detrimental to the bike industry? And conventional wisdom, or when you read forums, is private equity is horrible for the bike industry. And
That's the clickbaity
yeah, and I
version.
would challenge that a bit, and I think that's an area that warrants digging into a little bit more deeply, and certainly I can talk a bit about my experience with private equity at YT. But I think even a better place to start is looking at what kind of ownership structures even exist in the bike industry.
Sure.
And for me, coming from outside, it was actually kind of surprising to see there's the bike industry itself is not typical of many other industries. You have, first of all, very, very few publicly traded companies.
Right.
When you talk about large organizations, car companies or Amazon, they're all publicly traded, and you have full insight into how the company's doing. The bike industry is actually heavily dominated by, I would even say, family ownership structure, specialized Trek, being owned by either the founder's family or, let's say, holding companies that are built around a holding company is a legal structure created for a small group of individuals who own a majority interest in the company.
Which isn't that strange. I mean, like Volkswagen or Porsche is still family owned, up until very recently.
Well, yeah,
Publicly
I
traded,
would say it's
family owned.
heavily, there's still families involved or who are majority or strong minority shareholders, but those
Right.
are still publicly traded companies.
Sure. No, you're right. Yep.
And even when you talk about founder-led companies, there are even fewer of those in the bike industry. I mean, you could argue that Specialized is founder-led with Mike Sinyard, but I don't work there, but my understanding is he's handed over the daily job to other people, while his family holding still has the majority of shares. I don't know if I'd go to say it's a founder-led company anymore. And there's basically only a very small number and more boutique brands that are really truly founder-led.
Sure.
So you have a lot of family holdings. You have institutional investors. So you have things like Scott or
Pawn.
Yeah, Pawn, that's a family holding. Actually, Pawn is owned by the
Okay.
Pawn family. You have but when you have Scott, which is owned by Young One, or you have Rafa, which is owned by, well, I guess you could say that's the Walton family. So that's kind of between institutional investors and the family holding. But most of these, at the end of the day, are privately held. So we have very little insight into how the companies are doing. And I think that's also a reason why there's a lot of speculation in the bike industry. How are things going? It's hard to look at data. You have Shimano, Giant, Merida, Fox Factory that you can look at as publicly traded companies and get a sense for how they're doing. But that's just a fraction of the bike industry as a whole. And that leads to a lot of intransparency around, how bad is the overstock situation? How much money are companies actually losing, or are they making money? These are things that you, as an outsider, you have a hard time. Even for me too, I have a hard time assessing how some of these larger companies are doing. And maybe that's one caveat that I should bring into this conversation. I'm very heavily mountain bike focused. So while I have a great deal of transparency into how things are going in the mountain bike industry, I'm less familiar with road, commuter bikes,
Gravel,
cargo bikes, gravel. I might know some, but I'm my experience is going to be heavily mountain bike focused, and I'd like to stick to the areas that I feel most comfortable in.
So this situation, do you have any kind of ideas why? I mean, I have my ideas, which is this is a passion business. It's a small, relatively small business. It's a niche business. I think that's why, from my vantage point, that there aren't more sort of holding or publicly traded, just because the size of the businesses are much smaller.
It's true. It doesn't make sense to take a company public unless it's large, but there's still a lot of large businesses that could be taken public, which have not been taken public. I mean, Specialized Trek could certainly go public if they chose to do so, and the families have chosen against it. I mean, going public leads to, you can make a lot of money short term by selling a lot of your shares, but it forces you then you have to report on a quarterly basis, annual basis, and you all of a sudden shift from being a long-term value-driven company to a, short-term maximizing return for your shareholders, which does change incentives. And I would totally agree with you that I think passion is the right way to look at this. I don't think there's a ton of people. You don't go into the bike industry to become rich normally. I would not advise people to pursue a career in the bike industry if your number one priority is making a lot of money. Not to say you can't make money, but it's in general, an employee working for a bike company is probably going to be paid at the lower end of the compensation distribution. You could go to other industries and make more money.
It's a slow growth industry in general too. I mean, it's a slow growth industry.
But I think it's also the fact that there's a lot of people who would prefer to work in the bike industry than work for insurance. And when you have that situation, then that depresses wages that you have to pay. People are
willing to earn less, and I think that goes all the way up to the ownership.
Correct.
I think that it's across the board.
Yeah.
Because it's sort of it's funny. I keep circling this topic, but it really touches so many aspects of the businesses, that the nature of the business, that it is sort of, there's this premium that you have to pay, or discount, I guess, you have to pay to be in the business.
Yep.
Because it's cool. And I suppose the movie business has similar aspects. Music.
Yes, you're exactly right. This is not unique to the bike industry.
Right.
Anything that's associated with passionate employees, or I mean, you could even say people who work for nonprofits. It's a similar thing, right? You don't make money going into nonprofits, but you feel good about what it is you're doing, that you're adding value to society. And I would say for people in the bike industry, it's maybe not that extreme, but you go into the bike industry knowing you'll probably undersell yourself versus what you could make for working for other companies, but you have a feeling, people who are passionate about the product are excited and proud of what they do. And I was the same way. I mean, I took a pay cut to go to YT, but that was totally fine because I got to work in the industry that I had been an enthusiast in for my whole life. So it was for me a no-brainer. Like, absolutely, I would do it.
Hey, it's Wyatt here. So here's a stat that should get every cycling brand's attention. 65% of all product searches now begin on Amazon. Not your website, not retailer sites, Amazon. Here's a question for any brand managers or business owners listening. Do you know who's selling your brand products on Amazon right now? chances are your distributors and dealers are already there. And if you're not actively managing that presence, you're losing control of pricing, brand story, and your customer experience. So my agency worked with cycling brands, and we help build and manage their Amazon presence, from listing optimization to driving sales, as well as Amazon advertising. We've helped brands increase their revenue by 50 to 70% in just the first year. So if you're interested, you can drop me an email at wyatt@velomedia.io. That's wyatt@velomedia.io. Now let's get back to the show. And then, so taking that, that's
Yeah,
something
I
that
think
touches all of the business. But going back to PE in general,
yeah.
maybe we can just touch quickly on like
Yeah, so
PE's
PE
relationship.
owned, so there was, I mean, maybe I'll start here with my story a bit about YT. I joined YT at the end of 2020 at a time when it was privately held. So there were two owners of YT at the time. That was the two founders, Marcus and Jakob. And in December of 2020, Canyon, which had a minority private equity investment, sold the first PE that had invested in the, I think, 2016 was sold to another private equity company, GBL, and that sale was, well, it wasn't publicly how much actually they paid for it. It went really, really well for the PE that sold and for
The founder.
the whoever owned the remaining ownership structure of Canyon. So, and even more important, in 2020, this was certainly big time boom in the in the bike industry.
Sure.
Unlimited demand, problems with supply, but let's say unlimited demand, and a lot of reasons to believe that the industry was going to continue to grow really strongly. And there was private equity all of a sudden had woken up to the idea of the bike industry as a future growth area. And there was, I would say, a bidding war on investing in Canyon. There were multiple companies, multiple private equity companies who wanted to acquire that stake. One company got it, and they paid a premium for it, and a number of companies were unsuccessful in getting that stake. Through that process, though, a lot of private equity companies did a lot of due diligence, so looked into the bike industry and said, okay, does it make sense to invest money here? And what I think they saw was very promising. You had an industry, and this is kind of one of the assessments that I had outside in. The bike industry is full of passionate people, but it's also very insular. There's a lot of people in the bike industry who have either stayed at the same company their entire careers or who have switched between bike companies and have never seen anything else. And while it might be true that the company you work for does pretty well compared to other bike companies, if you benchmark the bike industry versus other industries, particularly automotive, the bike industry is behind the curve, let's say, or there's many opportunities to improve how decisions are made, processes, systems, level of digitization. And I think private equity looked at this and said, wow, the industry it's not huge, but there's a lot of reason to believe that it will continue to grow. And there's a lot of inefficiencies that sit there from, particularly if you look at supply chain, marketing to some extent, but I think supply chain and distribution is an area that it's just not. I mean, as a bike customer, it's not, you're not in it because they do a good job serving you. It's the way you get your bikes. And I think that's how private equity, when they look at making an investment in a company, they want to see growth potential of that company, but also potential for the industry as a whole to grow. And I think they were not incorrect in seeing that there's a lot of potential in the bike industry to do things better than are being done, that has been done and continues to be done. And I think so. These companies that tried to invest in Canyon that were unsuccessful, they then turned their eyes to other potential investments because they looked at the industry and said, "Wow, there's a lot of opportunity. What other companies are out there that are still privately held that we could potentially acquire an interest in?" And they reached out to Marcus at that point, among others, I'm sure. And Marcus had not decided. The discussion when I joined was not, we're going to sell to a PE tomorrow, but the reality was, 2 months after I joined, Marcus and Jakob came to me and said, "Yeah, so we're getting a lot of interest from the private equity side of things, and we think we want to sell because, from what we can tell, this is a good time to sell." And absolutely, it was the best time to sell in
They were
hindsight.
right. They were right.
They were absolutely right. And so we entered the process of selling majority interest of YT 3 months into my job there. So it was
Wow.
adding on top of all the supply chain challenges which were going on. We were trying to sell the company
Jeez.
or selling a majority interest in the company. And I mean, here I think it's important also that people understand how private equity works. So private equity, I like to use the comparison of private equity to buying a house. When you buy a house, let's say you buy a house for, just to pick a round number, $1 million. If you want to buy a house for $1 million, usually you don't buy a house for $1 million cash. Usually you have a down payment of, I don't know, 20%. So 200,000, and then you borrow 800,000 from the bank to finance the rest.
Sure.
And when private equity buys a company, it's usually the same way.
Yep.
There's a down payment made, which comes out of the private equity portfolio, and then they borrow the rest
From a bank.
from the bank, typically, to finance the rest of the purchase price. And just like with a house, if the house increases in value after you build it, after you buy it, that's great. You actually get a huge return on. If you put 20% down, the house increases 10%. You're getting 10% back on a 20% investment. So you actually get an increase of 50% on your investment, let's say excluding interest. Similarly, with private equity, if the value of the company goes up, all is good. You pay back your loans and make a lot of profit because you've bought it. You haven't invested the entire amount in the company. The problem comes if price goes down. So if you have a house that you put 20% down and the house goes down by 20%, the house value, your entire capital is gone and you
Yep.
still have to pay the banks back. So you've lost your entire investment. This is the problem jumping ahead to where we are today. There were a number of private equity investments made in 2020, 2021, and even into 22. The Excel purchase by KKR came actually mid to late 22, which for me really surprised. That was probably the most obvious bad investment, which is surprising that KKR did it, seeing that they're one of the most well-known and reputable private equity companies. Investments were made at the peak, and since the peak, the prices or the value of companies has gone down. And while they're still positive, a lot of companies are still, I mean, not YT, but many other companies are still positive in what their value is. It's lower than what the investment had, which means
Right.
that the private equity companies are liable to lose their entire investment, even if they're still getting some money back for the companies they're selling. And this is leading now to a lot of challenges, not only in bike industry, this is also in other areas where private equity invested in the boom years of investment in Corona. That there's just the company values have gone down, and it's like when real estate goes down, people don't sell, and private equity just doesn't sell right now because they're not able to make the return that they were hoping for when they made those investments.
So yeah, I mean that's like a really it's a easy kind of to follow microcosm, and what happened was that this type of I mean it's not surprising that that there was a lot of demand. It's not surprising that Marcus and Jakob and you guys were like, hey, look, this is like there's a lot of demand out here. Let's see if this works. But and then there is like a cyclical increase in interest in cycling, globalization or urbanization, global warming. So like this is it's an interesting business to be in, with all the caveats that we talked about earlier about the discount that you have to take to be in the business and the relatively slow growth compared to possibly other businesses. So everything kind of was upside down at that point, which, based on everything else that we know that I've really kind of talked to, ad nauseum at this point about COVID, but it has touched everything. And so what happened then was YT, they were underwater with regards to their investment. They probably looked at the time horizon that they had to recover the investment and said, this just doesn't make sense for our portfolio. And then I presume that was the reason that they walked away. And I think that's also kind of common knowledge at this point was why they allowed the company to go bankrupt.
Yeah, so I think this is a good point you make. So when a private equity company makes an investment, and I'll keep the house analogy going. If you buy a house and you can hold on to it for 20 years, you can allow the value of the house to go up or down during the period you're holding it, as long as when you sell it, you can make more money than, or ideally you make more money than when you put into it. with a private equity company, they raise money from investors and typically have a 10-year maximum time horizon to give a return on the money that was given to them. So in a private equity investment, the most common one is that you have a 5 to 7 year time horizon. They buy a company, they hope that it increases in value, or they try to work with the companies to help increase the value. And then they sell them after 5 to 7 years and hopefully deliver a return to their investors. If they see, since this 5 to 7 year time horizon is fixed, if they don't see a path to making money within that 5 to 7 years, and they can't wait 10 or 15, then there's no reason to stick it out. And I think that's, I mean, I should say I have not been privy to the conversations
Sure, of course.
that happened at the end between the private equity company and YT. But it would make sense to me that when they're looking at their investment, that the turnaround for YT, for it becoming valuable enough to offset the loans that they had for the bank, because I think this is important. You have the loans to the bank you have to pay back, and you don't make any money until you've paid all those loans back. And if they, borrowed a large portion of that, the company would have to be worth at least as much money as they borrowed plus interest for it to be worthwhile for them to continue to invest in the company.
So
And
if the loan is
a
yeah.
big difference between a family-owned company who might say, we're confident that this business will turn around. It might take 10 years for it to be really profitable again, but it's worth putting in money now because we feel confident about the long-term viability of the company.
Right. And
And
that's all they do. They don't have, because these private equity firms, they have, dozens of investments. And so when they do see this type of a prospect where there are just kind of rules, I suppose that, okay, if it's this way, based on based on the way that this fund is managed, the money that they are investing, it just doesn't make any sense for them to proceed. Now, would this be, if we're looking at, I know we don't have, there are other situations that are out there that we've seen rumblings about. I know that Excel, which is owned by KKR, White, Fox Racing, Canyon, Troy Lee, like they are all in
yep.
not similar situations in terms of the amount of liquidity, I suppose, but they would have felt the similar
Yes.
market
I'm
conditions.
assuming that all of those companies are worth less today. I mean, all those companies you just mentioned were sold to private equity between 2020 or say 2020 and 2022, or a controlling interest was sold to private equity. And I'm assuming every single one of those companies is worth less now than it was then.
And this
And
isn't
that's
exclusive to private equity. I mean, there are family offices that purchased
every bike
investments as
company. I
well.
think
Yeah.
there might be a couple of exceptions. Companies that didn't exist in 2020 that have come out of nothing. There are a couple of boutique brands that are growing. So I wouldn't say it's everyone, but certainly large brands. Everything I've seen, those companies had a huge. There was a lot of expectations around
Sure.
which direction the bike industry would go in 2020 and 21. And even though the top lines probably haven't changed too much, even when I looked at YT, the top line didn't. It's not like it massively grew or massively contracted. It grew slightly over time in general.
The margin,
The margins are a
the
lot
margin.
lower,
Yeah.
and the growth expectations have become a lot lower. And then the amount that the company is worth when growth is slower goes down.
So
And
there
so I
was,
think all of those PE companies, are going to sit in a situation where they're probably going to lose money on their investment. And that's, puts a lot of pressure on the management teams of each of those companies to try and, if they get to a point where they want to sell, they're going to have to increase their profitability, cut costs, because the valuation of a company is a direct function of how profitable the company is, how much absolute profit the company is generating each year.
right. And for the uninitiated, typically a company, how is a company valued?
So at least with private equity, they look at the EBITDA, which is the profit.
Earnings
Say one of
before.
the types of
Yep.
measuring the profit of a company, but to say it's the absolute profit of the company multiplied by what they call a multiple, and the multiple is it's higher if it's in a growth industry and lower if it's in a stable non-growth industry. And the way you can look around that is if a company is making, using a million, again, if a company is making $1 million profit every single year, you can say, well, over the next 5 years, it's going to generate 5 million of profit, and future revenues or future profit is worth less than short term. So they call it discounting. They look at, okay, I'll be getting 1,000 every single year or 1 million every single year for the next 5 years.
In profit.
And I think I'll attribute a value of 5 to that. It's worth 5 million, that company. When you have the peak in 2021, bike companies were selling, and this is public information, around multiples of, let's say, 12 to 16, 17. So I don't know, let's use 15. So 15 times EBITDA is what you get for a company. And my understanding in the market today is that a brand is probably only getting 7 to 9. So half that multiple, because the growth is lower and investors are less keen to invest in bike because of the pain that's many of the investors have had the last couple of years. And then you have to also look at how the bottom line has changed. So you have, if bottom line even is flat, just through the multiple drop, you have half the valuation of the company. And that obviously is painful for anyone who wants to sell in that environment. And then they are incentivized to hold on if they feel that things will turn around. If you could hold on for 5 more years, and maybe it's a different situation. Or do you need to cut your losses and then say, we're going to write it off and move on to something else? And that's in this sense what I think the PE in YT situation did. They didn't see the path anymore and moved on. Yeah, which was obviously painful for all the employees and and not just, the PE lost a lot of money. The management team in YT lost a lot of money, and certainly the employees who lost their jobs lost everything. So it's been it's been sad for me to see. I really feel for everyone who has been impacted, and I'm excited to see that Marcus is trying to find a way to make it work in a new setup, and I certainly wish them nothing but the best to try and turn it around. I think going through bankruptcy is never easy. The toll it takes on all the people who are involved and on the brand. And I'll be curious to see how it develops.
Yeah, no, I'm glad that Marcus is back in it. It's going to be a hard road, obviously. But going back to kind of what you had mentioned, this sort of perfect storm. So if you do talk about like what makes these companies valuable, is specifically tied to the amount of profit that they're generating each year. You said EBITDA, which is earnings before interest, depreciation, and amortization, which is just like a fancy way of just saying that this is your profit. If Charlie Munger were here, he'd probably say it's BS earnings, but it's just a way to kind of measure your profit before of all the depreciation of the assets that you bought and the interest that you have to pay. So basically what happened was, is if you were going to dumb it down into like a really simple equation, the market conditions before or during COVID, there was a time where the market conditions and the sentiment and the interest rates were generated sort of an exuberant amount of activity towards the cycling industry. And anyone that sort of bought in that span of time was overpaying. That's an objective fact.
Yes.
They overpaid.
I think in hindsight, absolutely.
100%.
Every single investment that was made, and
regardless if it's PE or family offices,
correct.
Right?
Or even, I think Specialized purchased back a minority share from Merida in 2019. I bet that also was overpaid at that time. Although it's probably, in the long term, it probably is fine. But there's any purchase that was made there. Yeah, absolutely. It was a perfect, I don't want to call it a storm, but it was a perfect alignment of, as you said, low interest rates, which makes it easier to borrow money, high growth expectations. Bike companies were super profitable in 2020 and 2021 because they could sell every single bike without any discount.
Full price.
And a lot of companies had overstocks from 2019 that they normally would have had to discount to sell, which all of a sudden was valuable. So you had somewhat inflated revenues and certainly inflated bottom lines because margins, you didn't have to discount, and you were actually companies that had large overstock situations going into COVID actually had an advantage because they had more inventory to
Right.
sell when things slowed down in terms of the supply chain challenges. So things were kind of turned on its head, that companies that maybe would have had problems had Corona not happened, all of a sudden could generate even more revenue and look even better on their balance sheet.
On paper, yeah.
On paper, and then obviously everyone was excited about the potential, and then things got flipped on their head when the bikes didn't arrive for a long time, and then all of a sudden everything seemed to arrive all at once
Right.
towards the
And
end of
then
22 and into 23.
and so by going into that, then just kind of putting a bow on this is, so because of then the overstocks and everything like that, that and inflation, which we're not talking about. I mean, like obviously discounting is important in the equation, but interest rates flipped. Sorry, interest rates flipped to where money got more expensive.
Yep.
So that makes the value of companies
Go down.
sort of downward pressure on the value of
Yep.
companies. Then you've got inflation, which
Yep.
which is something that increases the cost of inputs to these products.
Correct.
Then you've got pressure from the overstocks, which increased the aggression on the discounting side of things,
Right.
which compresses margin again.
Yeah.
So like basically all of the things that helped the valuations increase basically drove
turned on their head.
Margin was downward pressure to margin.
That's right.
And so all that contributed to essentially a complete like 180 in the valuations of bike companies in general.
Yeah, not just valuations, but the bottom line, which
Right,
is
which are
even more important
determined
than
by valuations.
Yeah.
So we get into a situation where it's been flipped, and everything now is looking like what we're seeing in the market. Like what I guess. So now I think we sort of painted the picture very clearly, which I'm really glad we were able to do that, because this is helps people understand what's happening. Even brands that have gone through restructuring, that you're hearing having to go through restructuring, they're all feeling this. Everybody's feeling this. And I guess my question then would be, what do you say to these companies? Like, I'm not that we have the answers, but like, what are some of the possible outcomes here that we're going to see?
So I think, if you talk about a private equity owned company, they're going to have to sell at some point. So if you look at KKR or so KKR with Excel, GVL with Canyon. I actually don't know the names of each one by heart, but you have Troy Lee and you have Fox Racing and you have White. That was actually just purchased, so that's down now. They have a new 5 to 7 year window. So let's say there's some time now to do things there. Those companies are going to have to find a new person to buy the company. They're going to have to sell it to somebody.
Because private equity has like a hard stop on this.
Yeah.
Or like what
so
is
they
like,
have
what
two
is
options when they have to give the money back to investors. So they can either find a new investor to buy it, or they can buy it from themselves. That's another option that they can do and say, I'm going to create a new fund and I'm going to buy the company from myself to pay out the old investors and bring in new ones.
This is like contractually obligated by these funds. Like it's in their covenants where it's like you have to give the money back to the investors.
That's right.
Oh, okay. Then who eats it if it's negative?
Well, that they don't want. I mean, the investor. Then it depends on how the portfolio looks. Because if you look at a private equity fund, they don't buy one company.
Right. They buy several.
If you think about the housing one, they're buying 50 houses.
Right.
And ideally in different industries, and they diversify the investments. And if there's one that fails and all the other ones are positive, it's not a big deal, right?
It's a
they
wash.
can compensate that. If the problem now is there's a lot of companies that were purchased in 2020 during the e-commerce boom of Corona that are worth less than at the time, and so there's a lot of private equity investments which are they use the nomenclature upside down.
You have underwater.
They're worth less money,
right?
And then the investors, who invested assuming that they were going to get a 10% return per annum on these investments, are now, and the private equity funds who don't want to kind of prove, or when they close the fund and say, yeah, sorry, everybody lost 10-20% on the fund,
which is a write-down.
That makes it hard for them to get. I mean, they lose money too. They have their own money invested,
of course.
But then it makes it hard for them to get new money to invest in new companies.
Okay.
So they're incentivized to try and find a way to make it work that it's at least positive. But at some point they have to close it. They can buy it from themselves with a new fund, but that's harder to raise money for a continuation fund because usually
Right.
you only do continuation funds on stuff that's not working.
Right.
And you have to also make a decision. Do you pay out the old fund with a premium, let the old people get a better deal, but then give even harder for the new ones? Or do you do it the other way around and say, let the old people suffer and the new ones get a better start for the next investment? And usually, I mean, they try to do a market price, but then how do you evaluate a market price? It's a bit challenging. I would imagine most of these companies will sell to somebody else. And that's why you see a lot of situations with founders buying back companies.
Right.
Kona bought back
Yep.
by founder,
Yep.
YT bought back by founder, because the companies, if the company is losing money, it's theoretically a valuation of zero, and then you
And
can buy
maybe
the
only,
company for €1.
yeah, or the founder
And
can unlock some of that value a little bit
yeah,
easier.
and so companies that a person sells the company in 2020 or 2021 makes a ton of money. The industry goes down, the company's worth nothing. You can buy it back for cheap, and then kind of move things in a different direction again. And the owners and founders often they understand the business well and usually have a
Sure.
pretty clear plan about ways that they can turn the brand around. And
100%.
let's say make it smaller and leaner. And certainly bankruptcy gives you the opportunity, if you go through a bankruptcy, it gives you the opportunity to restructure a company at a speed and a cost that you can't do if you try to do it running the operations normally. It becomes really hard to cutting costs out of a company is not. It takes a long time to do it. If you're trying taking cost out is a lot harder than adding cost in, except in cases of bankruptcy where basically all your contracts are voided and you can get out of things.
And then with regards to family owned businesses,
Mm,
obviously we can see kind of where the advantages of the family offices where they have
yep.
longer time horizons and there's not all this pressure to exit. So this is where again it goes back to, sort of an incompatibility in a lot of cases where, I mean, by no means do cycling brands not need capital, which, there's situations where, I mean, I don't think that this is like, by any means, we're saying that private equity is bad for cycling. It just happened to be bad at this moment because
Yeah,
of the
and I think
characteristics.
it's important, Wyatt, that my assumption, and I don't know, I mean, this is speculation, but my assumption is that the majority of owners of bike companies have had to inject cash into their
Of
businesses
course
for
they
them to
have.
survive.
Of course they have.
So this is not like private
Yeah,
equity messed it up
right.
and they're the only ones suffering. It's that you just don't hear about it because it's not reported. But I'm certain that, I mean, with KKR, I know they have invested a lot of money in Excel that they've put in their figures, but I'm sure that companies, big bike companies, they're holding their owners, which is simply the families who have made money on the company in the past, have
Right.
now said, okay, we need to inject, I don't know, 10, 50, 100 million, maybe even in the big ones to so that they have cash to survive and
Look
get
at,
through this.
yeah, look at,
And those families will only do that if they feel that there's a long-term viable option to recover that money. And if they, we haven't seen big companies, privately held companies go under. And I don't know if that's, I doubt that that's because they've been so much better managed than some of the smaller companies.
no, I think they
I
have
think
some
it's more that
money in the
there's
bank.
big pockets behind them and
Yeah,
they can
or
hold it out, right?
long
They
term.
can
Yeah,
make those investments and they look at it and I would agree that there's a lot of reasons to still be optimistic about the mobility industry in general.
100%, 100%.
So if you say I have a 5 to 10 year time horizon or a 10-year time horizon, let's say, stay away from the private equity five, that there's, that can still be a great investment. And I think, they have a lot of these family founder-led companies
Or
also
family
have a
offices.
strong association with the employees. They want to maintain that, they want to be loyal to the employees and to their suppliers and have let's say are invested in the industry and then are it's a further argument for to try and make these investments and not have to do mass layoffs because that's I read about Campagnolo this week,
Sure,
which
they
is
had to
certainly
kind of
really sad to see. And I'm sure they've tried to invest money in the past, and now it just doesn't work anymore. They have to.
right
The
size.
family doesn't see it anymore, and then they have to do some significant layoffs to cut their cost base.
Right. Right. And that's an interesting one there because they had like obviously costs that were out of control based on, where the business is now. So those are the sort of adjustments that they have to make. But that's again, like family offices. have the same dynamics with regards to, the margin pressure, but the family offices, maybe just to make a quick clarification, generally family offices are funds that are owned by a family or members of a family or a
Yes,
person, and they make investments very similar to what private equity does, but they just have
correct.
much longer time horizons, without the without the sorts of covenants that we were talking about.
Right. They typically don't take money from banks either to at least to borrow money to acquire companies. And I think that's the private
Sure.
equities make it's a high risk, high reward.
Right.
If you're
Right. Right.
borrowing money, it's like real estate speculation. If you're borrowing money to buy real
They're
estate, you
leveraging.
can
Yeah.
make a lot of money if it goes well, but if things
Right.
go poorly, you lose everything.
Right. Well, Sam, we're bumping into an hour here. I have other topics that I want to talk with you about, but we're gonna have to save this for another one, man. Hopefully we can get you back on. I know you're very, very busy. But this was an awesome conversation, man. I think we brought shed a lot of light onto this kind of world of PE, and I don't think we were that negative. Like, because I don't like to be negative about anybody's business or any sort of business. I don't think we were negative. I think we talked about facts.
Yeah, and that's good. If you don't mind, one last comment on that.
Yes,
I do
of course.
think so. Private equity in general, they're not stupid people. There's a reason they see opportunity in an industry, in investment. And in general, they ask a ton of good questions, bring a lot of experts in to help you navigate difficult situations. And I do think that in a more stable environment, private equity could lead to actually a lot of positive
Oh,
developments
it does. It does,
within
and
the
it
bike
has.
industry, just as it has in other industries.
Does, and it
And
has.
certainly, if I look at the bike supply chain, there's still tons of work to be done across the
Absolutely.
entire value chain. Maybe that's what we should talk about next time. Is
I
all the
want to.
opportunities
I
that
do. I
exist
want to.
in digitizing and making the supply chain and making it much more efficient, because everyone would benefit from that. Customers, the companies, the suppliers. It's actually mind-boggling at times for me when I look at it how antiquated and inefficient everything is set up. But that also gives me reason to be very optimistic that if these things can be improved, and it's not easy because one company can't do it alone, it has to be done across the industry. If investments can be made, that will lead to better outcomes for everyone. And I'm including customers in this too. You should have cheaper bikes, better customer care, more transparency around what's available, faster faster
Warranty.
turnaround on
Yeah.
changes, and getting the product to market faster, which typically leads to more interesting products too. So I'm not a I'm a private equity per se is not bad. It's tricky. There are and that 5 to 7 year time horizon is perhaps the trickiest part of it.
It's risky. It's risky. It's
But in
risky.
general, I'm not. As I said, I'm not. I wouldn't categorically say any private equity investment is bad for customers or bad for the industry. But certainly, where we are right now, having family owned has been very beneficial.
Right, right. More compatible.
Yep.
Well, thanks, Sam. This was awesome. If people want to get in touch with you, where can they find you?
LinkedIn's probably the easiest way to find me.
Okay. Sam,
Sam
Nicols.
Nicols.
I always put the H in there. It's always wrong. Okay. Well, awesome talking with you, man. Appreciate the time, and hopefully we can do this again soon.
Sure. Thanks, Wyatt.